Money Effect, where I bring you all news, money, and finance related. Just a short disclaimer, this is not a financial advice and strictly for educational purposes, and it's just my opinions. If you like the video, hit the like and subscribe for continued content. And now that's out the way, let's go. So the topic I want to touch on this week, and I want to, kind of provide a summary for everybody about what's been going on the main news in the financial markets, is inflation. So I've been discussing this from last year, and it's really now coming to a boil this year where, inflation, is still trending upwards, and it's particularly affecting the technology stocks, the growth stocks, the Palantirs, and even the big tech stocks like, the Apples, the Facebook, the Googles, and those are all best seen in the Nasdaq. So the Nasdaq is like a technological index, and it's just basically made up of technology companies. It will also affect like the S&P, for example, because those companies are so big now. They're on the broader indexes, but you can just see here the Nasdaq. It's been down for the last 2 weeks. On Monday, it crashed, and it had a good comeback, but it literally it went so low on Monday, and that's because of inflation. Um, so why? What's the reasons? What's going on with inflation? Look, we're back here again. So this was actually on Wednesday, but before Wednesday, inflation is now at 7%. Prices rise at rates unseen in decades. So inflation, we've discussed, it's the price of goods. Things are getting more expensive, and when inflation is high and things get more expensive, and you're going to the shop and you know things are more expensive for you. Naturally, you're going to buy less. You buying less, the shop's making less money. The shop can employ less people. Those less people can't go out to their clubbing and spending. The economy's going down. So that's why inflation is not a good thing, um, especially if it's not, at this kind of level. Inflation should be about 2 to 4%. So that's what's going on right now. We've had inflation is rampant. It's causing the markets to go low, and it's really a case of, what's going to happen now. The market is pricing in the Federal Reserve now. So and this is not just in the US. This is in the UK. This is in Europe. And we've seen in the UK, we've already had an interest rate increase. America are not so yet to do that, but they are reducing the money supply, in just taking money out of the economy. Again, we've got the ECB talking about they're going to do everything to get inflation to 2%. So these central banks are going to be pushing. So what is the situation now? The situation why it took disastrous this week is because, you know, analysts and the market say are predicting that, we're going to get some rate rises this year. Now, taking just the America, for example, they're predicting 3 rate rises, but now they're saying, no, we might need more. Now, if we get 3 rate rises this year, you're going to see tech bounce back, and all these growth stocks are going to bounce back because that's in line with expectations. That's already priced in. If I told you, if you're betting on a football match, for example, and beforehand your best player in the team is injured, you're going to be like, oh, well, I can already factor that into who I think is going to win this game. Obviously, if your best player gets injured during the game and you can't factor that in because you don't know that's going to happen before the game. So right now, the market is saying, listen, we're going to get rate rises. We know we're going to get rate rises, but right now it's free. The problem is if inflation keeps on getting out of control, then they might have to be more drastic. So how is the Federal Reserve going to react? So on Wednesday, the Federal Reserve, they held a meeting and they basically said, yes, listen, and this guy, Jerome Powell, he's the head of the Federal Reserve, and obviously America is where most of the world economies take their cue from. So that's why we focus on America. And he basically said, listen, he's changing his theme now. So he's saying, yes, um, we're going to need to raise rates. But at the same time, the market rallied. Why did it rally? Because he said, yes, we're going to need to raise rates, but he's still using this word. He's still using transition. He's still saying transition is temporary. Once Omicron or COVID or whatever this one is now, once that's all out the way, the supply will get more supply. That will take inflation down. People will start going back to the jobs. So then, when we do raise these rights, that won't raise these rates, that won't hurt the economy. So he's still, although he's being a bit more, he's admitted now. It's like somebody is saying, like, you're in school and you're with your big brother, and you're going into a fight, and your big brother's like, yo, you've got this, man, like, you've got it. And then as the fight's taking place, your big brother's like, yo, I might have to step in and intervene, but I still think my little brother's going to handle him. But let me just let him know that, don't worry, like, I'm here if you need me. And that's kind of what the Fed chairman is saying. He's like, yo, okay, maybe inflation is a bit more persistent than we thought. We're going to need some rate hikes, but it's still not as dramatic as that. We're still transitionary. Once this variant's under control, we get supply lines back under control, people start going back to their work. When we do raise these rates, we'll have a lot of scope to raise them, because they won't hurt the economy, because people will be back in work and inflation won't be as high. So that's what Powell is saying. Now, whether you believe that or not, I don't know. The market didn't believe it on Monday, because they thought this guy's way behind the curve, and that's why tech dipped and all these growth stocks are dipping. I don't know. Like, do you? I personally don't. In my opinion, I don't believe that. I think inflation is a lot more. And this guy's still up for nomination, so it's kind of like he's still in the job interview. I feel like inflation is a lot more rampant than they're expecting, and they're going to have to raise rates a lot more than the market's priced in. So I think we these growth stocks and tech stocks might have further to fall. Will have further to fall. That's my opinion. You don't have to. This is just my opinion. I'm explaining what's going on. That's what I think is going to happen. Now, also, this is also affecting crypto. So if we take it going into crypto, so crypto has been falling. Again, crypto has been falling. Now, crypto is a bit of a funny one, because Bitcoin, for example, is seen as a store of value. Now, that's the new. It was seen as a payment method. It was seen as something else. Now it's seen as a store of value. The problem is, crypto has been falling because inflation has been going so far out of control that they're thinking, "Wait, hold on, the Federal Reserve, these banks, they might have to do something dramatic to get inflation under control, i.e., take away the money supply, take away, raise rates further than we're expecting, and obviously that's going to have a negative effect on crypto. But if we get inflation steadily rising at the 3 to 4%, 5% level, then yeah, crypto is a good store of value to hold your money. But if this inflation gets out of control and these central banks have to do a madness, then crypto ain't a good place to hold your money. And that's basically the way Bitcoin is playing out now. It's kind of playing along out. And if you've got a portfolio and you've got Bitcoin exposure, crypto exposure, and you've got a lot of tech and growth exposure, you really need to look at your portfolio, because right now they're kind of moving in twine. And again, look, we've seen on Monday, boom, when the Nasdaq dipped, boom, crypto dipped. When it came back, when Powell by Wednesday, when Powell was talking all that good stuff, you know, uh, up to when he was talking, it was rallying. So it's definitely moving along that line of inflation. So this year, like, inflation is going to be the main theme this year. This is it. I've been saying it from last year, and this year, no doubt, is inflation. It's going to affect, if you're in tech stocks, growth stocks, crypto. Inflation is key. Value stocks, that's a bit different. As the world comes on back online, you know, that inflation will be good for the cyclicals and value stocks. But either which way, you need to know what's going on with inflation. And this is just a video to kind of just explain what's happening. So, in summary, uh, what do I think? Like, we've got basically three main things are gonna happen now. These banks, although we've got the ECB saying they're going to do everything, Powell is kind of now putting one foot in the ring. Obviously, the UK, they've already raised interest rates. They potentially could turn around and say, listen, with this Omicron, um, we don't want to raise interest rates too further now, because nobody wants to be the guy that destroys the economy. So they might say, you know what, let's just fall back. Let's just let inflation do what it's doing, and let's not destroy the economy. And we'll handle this later. Now, for Jerome Powell, that might not be good, because he's up for re-nomination, so he's gonna be the one handling it later. So they might just kick it down the can, back down, which is what they've been doing. So we might see that. Secondly, now is for governments. Governments. We've seen a lot of some physical spending from, you know, And we've already seen the infrastructure bill has been pulled in America. In the UK, they're taking away certain spending that's been put in place particularly during the last 2 years. They're talking about, you know, um, increase in taxes here. We're getting a new NHS tax. Whether that will go ahead, I don't know. But the second thing is that the central banks kind of leave it to the government and say, take away all this physical support. And when I say physical support is like government spending. Take away all these government spending things. Take away all these things you had in the furlough period, and raise taxes. Raise taxes. Bring in things like this new NHS tax. Raise middle income tax, top rate tax, and then that will naturally stop people from spending, and inflation will come back down that way. So that's another second option. And obviously, the third option is the central banks, the governments don't do that, because the government, no, who wants, like, look in the news. I don't even, we all know what's going on with Boris Johnson right now. He's going through it, having all these parties in number 10, in living life during COVID. So he's going through it right now. So I'm sure the last thing he's thinking about is, do I now want to start hitting them with, I need to raise rates, and I need to um, raise rate taxes more, and I need to stop spending. He's probably going to do the opposite, to take away from the negative backlash he's receiving with all his parties to stay in power. So he's probably going to think, now we need to actually, that NHS tax that's coming out in April, we need to take that away. We need to stop that. So then people will love me again. And I'll keep my job. So I don't think the governments right now are going to be doing, they're going to gradually obviously take away things they've been doing, like the furlough payments, but they're not going to drastically cut down on spending, because they need, this economy is on a tether hook, and they need it to keep growing. So the third option is Federal Reserve has got to increase rates. The central banks have got to increase rates, and not only have they got to increase rates, they might have to drastically increase rates. They have to, first of all, they have to reduce the money supply, taking the money out of the economy and doing it at a quicker pace than they think. And then they're going to have to drastically say, you know what, we need 5, 6 interest rate rises. Because inflation, if we don't do it now, I remember everything's forward looking. So they're looking at inflation in 2 years' time, and they're thinking, listen, we need to do these rates now. If we don't do these rates now, in 2 years' time, this inflation is going to be so rampant, and the economy is going to be destroyed anyway, because nobody will be able to afford stuff. And not, shout out to Africa, AFCON, um, my Zimbabwean people, but we don't want to end up like Zimbabwe, where inflation is so rampant. To buy a loaf of bread, you're wheeling barrows. Like, if you remember, everyone remember, if you know that, go Google it. Zimbabwe inflation, you see them. They had to buy a loaf of bread. They had to take a whole barrel of money to the shop. We don't want to end up like that. So that's the three options they got, and I personally feel that they're going to increase rates further than we're expecting this year. And that means these tech stocks and growth stocks have got a bit more to fall. So if you're looking to get in and you've got overexposure in that, it's a good time now. Make it one of your resolutions, because it's going to be a big theme throughout the whole year. So cool. Hope that's given you a bit of understanding what's going on in the markets in regards to inflation. If you like my video, please like and subscribe. And yeah, to the next time, The Money Effect, signing out.